Hello, this chapter will explain accounting for long-term operational assets from the date of purchase through the date of disposal. So first, we will identify different types of long-term operational assets of any organization. We can distinguish between tangible assets and intangible assets by our ability to see and feel tangible assets. Intangible assets normally represent rights or privilege and are very difficult to evaluate. Property, plant, and equipment is sometimes called fixed assets or planned assets. Once we acquire a fixed asset, we depreciate its cost over estimated useful life. Depreciation is a systematic and rational method of allocating the cost of an asset over the periods benefited by the use of assets. Depreciation is a cost allocation scheme and has nothing to do with market value of the asset. Natural resources are usable assets provided by nature. Examples including oil and gas and coal deposits. The process of allocating cost of a natural resource is called depletion. The concept is very simple to depreciation but refers to the treatment of natural resources. Land is a productive asset, but it has an infinite life and is not subject to depreciation. Intangible assets. Intangible assets are divided into two broad categories: those which identify useful life and those that identify the first one is identifiable useful life and those that have indefinite useful life. Example of intangible assets with identifiable useful life include the patents and copyrights. These tangible assets are amortized over their useful life. Intangible assets with indefinite life include renewable franchise, trademark, and logo and goodwill. The cost of this asset is not expended unless it can be shown that there has been an impairment in value. Right? So now the second objective is to determine the cost of long-term operational asset. The cost of building include not only the purchase price but also the sales taxes that must be paid. The cost include the cost incurred to secure the title, for any real estate agency or for the attorney's fee prior to purchase and remodeling cost like construction, right? The cost of equipment includes is the net purchase price plus any sales taxes that apply. In addition, deliveries and installation costs are part of the cost of equipment. Finally, the cost to get the equipment ready for its intended use is included in its cost. Land included many of the costs that we have discussed for other productive assets. In addition, the costs incurred to remove, raise, or any old structure are included in the cost of the land. Grading and land preparation are considered part of the cost of the land. Now I want to introduce you another term we call is a basket purchase allocation. Let's assume that the Betty company purchased land and building for 240,000 cash. We know the building is depreciated, but the land is not depreciated. So we must separate out the cost of this bucket purchase. The company hire an independent appraiser to determine the fair market value of the land without the building and the building without on the adjoining land. Based on the best proposal, the appraisal, BT has determined that 75% of the cost should be assigned to the building and the remaining 25% should be assigned to the land. We are allocating the cost on the basis of relative fair market value. Given this information, we will assign 180,000 to the building and the remaining 60,000 is assigned to the land. The life cycle, any operational assets begin with acquiring of the fund necessary to purchase that asset. Next, we purchase the asset, being sure we including all of the appropriate costs in the cost of asset. After acquisition, we use the asset and begin the process of depreciating it. Finally, for any number of reasons, we may elect to retire the asset. The cycle starts on over again. In this chapter, we discussed about how the different depreciation methods affect financial statement. First, we have three methods of calculation depreciation expense of productive assets. The first method is known as the straight line method. Using this method produce the same amount of depreciation each period we use the asset. This is probably the most popular method in business practice today. The next method is the double declining balance method. Using this method produce greater depreciation expense early in the asset life and less depreciation in later years of asset life. The final method is known as the unit cost of production method. The amount of depreciation expense recognized in any given accounting period depends upon the number of units produced by the asset. So, we use this example for van purchase to demonstrate all three methods of depreciation. The van has the net cost of $24,000. It has a useful life of 4 years and an estimated of salvage value of $4,000. Let's start with the first phase in the operational asset cycle, acquiring sufficient funds to purchase the van. The company elect to issue 25,000 of common stock and use the proceeds to purchase the van. Right, so we have a cash increase of 25,000, common stock increase of 25,000, and we have a cash flow in. There is no income statement impact of this transaction. The journal entries is a debit to cash and credit to common stock. Now, the life cycle phase 2 straight line depreciation. On January 1st of 2013, the company purchased the van for its net cost of 24,000. Our cash account decreased by 24,000, while the van account also an asset increases by the same amount. On the statement of cash flow, the investing activity section shows a cash outflow for the purchase of the van. The journal entry is a debit to the van and credit to cash. Now step 3, life cycle phase 3. In the third phase of the life cycle, we put the van to use producing revenue. During the year, the van had to produce 8,000 in revenue. When we placed the van in the services, we began the depreciation. Under straight line depreciation, we calculate the periodic depreciation expense by subtracting the assets, the sales, salvage values from its cost and dividing the total by the estimated useful life. In our case, annual depreciation is 5,000 as shown in the calculation. As the van had produced the revenue, income increase of 8,000 and so on, so the equity increase of 8,000 from the balance sheet. In addition, we have a cash in cash account and cash inflow from operating activity section of the statement of cash flow. We record the depreciation expense which reduce from the income as expense and the equity section reduce 5,000 on the balance sheet. There's no cash flow impact of recording depreciation expense. If we use the journal entry to recognize the revenue is debit to cash and credit to the rent revenue. The journal entry to recognize the depreciation expense is a depreciation expense debit 5 and credit to accumulated depreciation of 5,000. Notice that the increase in accumulated depreciation results in a decrease to the book value of the van. So now we determine how gains and losses on disposal long-term operational assets affect financial statement. At the end of the asset's useful life, we determine its book values as the cost minus accumulated depreciation. In our case, the book value is 4,000. We are able to sell the van for 4,500, so we recognize against 500. The journal entry is to debit to cash 4,500, and we have a book value of the van is credit for debit credit for 4,000, but for the equity we increase the equity net earning is 500. The cash account is increased by 4,500 and we remove the van and related cumulative depreciation from our book. The 500 gains the increased income and the equity section of the balance sheet. In the investing activity section of the statement of cash flow, we show an inflow from the sale of an asset of 4,500. And here we can see the account title cash increase for 4,500. Accumulated depreciation is 20,000. The van and the value credit and the gain on sales of van. Now we move to the next method. We call this the double declining balance method. Determining depreciation expense under the double declining balance method is a three-step process. First, we calculate the straight line rate of depreciation. We do this by dividing the useful life into 1. Next, we multiply the straight line rate times 2 to get the double declining balance rate. Finally, we multiply the double declining rate by the book value of depreciation, book value of asset at the beginning of the period. Remember, book value is cost less accumulated depreciation. We ignore the salvage value in our computation. So let's calculate depreciation expense under the double declining balance method. Here we combine the two steps. We determine the straight line rate of depreciation by dividing 4 into 1 and we get 25%. Next, we multiply straight line rate by 2 and get the double declining rate of 50. In our table, we multiply the double declining rate by the book value of assets. In the first year, there is no accumulated depreciation, so the book value is 24,000. Add by 50% and get depreciation of 12,000. Notice that at the end of the asset useful life, we have over depreciation. Its cost less than salvage value. The maximum depreciation we can take here is 20,000. Under double declining balance depreciation, we must adjust the last year to make depreciation equal of 20,000, which an asset cost of 20,000 and accumulated depreciation of 20,000. The book value is 4,000, which we know is correct. The schedule on your screen shows the necessary adjustment to the depreciation expense. Under the unit production methods of depreciation, we first calculate the depreciation charge per unit of production. To do this, we divide cost less the salvage value by the total estimated units of production, and we got the depreciation charge per unit of production. Second, to calculate the depreciation expense for the period, we multiply the depreciation charge per unit of production by the number of units actually produced during the accounting period. So, we expect our van to last 100,000 miles. The depreciation charge per mile driven is €20 per mile. In this table, we show the actual mile driven each of the 4 years. In 2013, we multiply by 20 with time 49,000, driven to get the depreciation expense of 8,000. Here is a graph of the depreciation expense in each year under the three methods of depreciation. So now we will look very quick on to see how the expense recognition for intangible asset amortization affect financial statement. What does it mean, the intangible assets? A trademark is a name or symbol that identify a company or product like the words Coca-Cola or Pepsi. Anytime a company spends money defending its trademark, those costs are charged to the cost of the trademark. A patent is an exclusive legal right to produce and sell a product. In the United States, a patent has a legal life of 20 years. In today's increasingly global economy, it is become more and more difficult to enforce the patent rights. In many countries, we find wholesale reproduction of computer software and music and film. A copyright protects the right of creditor of intellectual property and extended period of time. In the United States, protection extended for life in the creator plus the 70 year. Franchise. A franchise is exclusive the right to sell a product within certain geographical areas. For example, you may have a franchise to sell the BMW within a certain area. BMW will not sell car to others in that area of protection. Goodwill. Goodwill is the asset of the cost over fair value of net tangible assets acquired in a business combination. The company is willing to pay the $450,000 to acquire the seller company. Here is the balance sheet of the company just prior to the transaction. As a purchaser, our cash account decreased by $455,000, but we received the assets of $500,000. In addition to getting the assets, we must assume the liability of seller. We paid the $450,000 to acquire seller company net asset of $400,000. The asset purchase price over the net asset acquired is called goodwill. Goodwill is recorded on our books as an asset. In the investing activity section of the statement of cash flow, we show a cash outflow of $450,000, the acquisition price of the company, and the goodwill. So, the journal entry to record the acquisition of seller company show a debit to the $500,000 and debit to the goodwill for $500,000. We have a user account seller's assets and seller's liability rather than list all the individual assets acquired and liability assumed. If we have an intangible asset with unidentifiable useful life, like a patent, we amortize the cost of the asset over its legal life of useful life. If shorter, we use a straight line method of amortization. We purchased a patent for $44,000 cash that has a legal and useful life of 11 years. The assets get decreased for $40,000 and assets the patent increased for $44,000 by the same amount. In the investing activity, we have a cash flow. We show an outflow of $44,000 for acquisition of the patent. At the end of the year, The first year, we recognize the amortization expense of 4,000, which reduce income and the equity section of 40,000, and the reduced income and equity section is balance of 4,000. We also directly reduce the cost of patent by 4,000 rather than use the unaccumulated amortization account. So we have amortization expense increase 4,000 and the patent decrease for 4,000. For intangible asset with indefinite life, like a goodwill, are carried at unimpaired value on our book. After our analysis of the goodwill account, we conclude the balance is impaired by 10,000. The goodwill account is reduced by 10,000 and an impairment loss reduced of income by 10,000. There is no cash flow impact to this transaction. The proper journal entry is to debt, or increase the impairment loss account and credits, or decrease the assets goodwill by 10,000. On this portion of the balance sheet, we demonstrate how property, plant and equipment, natural resources, and intangible assets are shown. Right? So we have a building amount less accumulated depreciation, so we have a book value, equipment with the less accumulated depreciation, we have a net value or book value, and we have a total plant and equipment. For land, we don't have a depreciation. For natural resource, already deduct the depletion, and total natural resources, we have intangible assets, patent, already less the amortization, we have a goodwill and total intangible asset and total long-term assets of the company. Now we will look at how the expense recognition choices and industries characteristics affect financial performance measure. Assume that Alpha company use a trade line deviation and Zeta company use a double declining balance method. Let's look at the partial financial statement. When we attempt to compare the financial position and result of operation of two different companies, it is essential that we are aware of any differences in the accounting principle used. In this example, Alpha company uses straight line depreciation and Zeta uses the double declining balance method of depreciation. Notice that the income of Alpha tends to be rather smooth because the same amount of depreciation is taken each year for 1,000. The reported income of Zeta is lower than as reported by Alpha in both the 2013 and 14. So here is the balance sheet representation of the asset of both Alpha company and Zeta company. Notice that the book value of the asset is higher than for Alpha during 2013 and 2014. However, at the end of the asset useful life, the book value of the asset for both companies will be equal. So we have discovered a wide range of this asset in distribution. We discussed accounting for depreciation of property, plant and equipment, as well as the natural resources and intangible assets. We need to be sure that you thoroughly understand how to depreciate an asset using each of the three methods we described in the discussion. Thank you for your kind attention and see you in the next video.